Good morning and welcome to the new edition of Dr. Lamba's Awakening Call. For the past few months, the gas fluctuations have raised a number of questions. People are asking questions about the oil prices and with that allied production, distribution, and exploration. All these are very complex questions and they relate to that part of economics that is not based on supply demand metrics. These prices are more geopolitical in nature rather than just simply a matter of supply and demand. And amazingly, while countries like India do suffer, but countries like Canada also suffer, while Canada is one of the world's 5 top energy producers, and yet it gets 10% of its oil import from Saudi Arabia. And the bilateral trade between the two nations only for the oil is $3 billion a year. You see, regulation and taxation of oil industry is not dictated by the market forces. It is a matter of political policy. Regulation of oil flows, as all economic flows among the nations, is viewed by the government more as a political function than as a pure market function. And this is something amazing. If it was a free market, there would have been no reason why the price in Venezuela would be 1 cent per liter, price in Iran would be 29 cents per liter, and price in a country like India would be 1.75. In Canada is 130, 32, depending on the day. So you can be sure that the oil prices are not the price of potatoes or other commodities. They are not determined by supply and demand of physical oil. One major factor in that, apart from the political policy, is that every barrel of physical oil is traded 9 to 12 times on future markets. And each trading activity increases, enhances the price of oil as far as the end consumer is concerned. Apart from that, because of it being traded on the future market, the speculators play a major role. Selling short oil is profitable when the prices are falling. And this can create an avalanche of sales that pushes the prices far below the fundamental value. This is also true again, and it's a paradox, when the oil prices start to rise. Forward buying can push the prices higher, much higher than they would have eventually settled. The demand for oil is basically inelastic. It has limited substitutes. And the oil quantities are not responsive to price change. A lowered price does not create an increase in demand. Let's be very clear about that. People say, okay, let's make this 1 day in a week oil-free day. But that's of no use because ultimately you need oil. Yes, some actions like carpooling, using more of public transport can have some effect. But since the product consumption and production is global, it has marginal effect. Another thing we forget, there's not the automobiles which are the major consumers of oil. It's the industry, it's the factories. And small changes in supply are almost exclusively reflected in price changes. So much so that the decrease in supply of 200,000 barrels per day would increase the price by just $10 per barrel. That's all. So 200,000 barrels supply is reduced, and the increase is just $10 per barrel, and that doesn't impact. And yet people, when I see, the economists smiling, well, the politicians talk about the demand and the supply and cutting off the production of oil by OPEC countries. Oil is essentially a transportation fuel and a production fuel. The third industrial revolution, as well as the fourth industrial revolution, cannot be visualized without oil. We might talk of all the alternative sources of energy, but their impact would be minimal. Today, oil is the largest single component of international trade, and is the lifeblood of transportation and cause of war. Consequently, today's global military, political, economic balance is mostly dependent on oil, the availability of oil. While oil is versatile and is user pervasive, the consumption and production are concentrated in very few hands, the OPEC, or Russia, which is not a major supplier. So this is a sort of monopoly. The consumption is global, the production is limited to a limited few. On the demand side, with the large industrial economies of the West, particularly the dynamic section of the Western Europe, and followed immediately by China and India. Western Europe, China and India are the major oil consuming nations. And unfortunately, India and China don't have the reserves. So they are dependent on imported oil. The domestic energy capacities are much below the consumption needs, and thereby hangs the tail. On the other side, a small group of developing countries, predominantly Middle Eastern, produce and export all their oil, primarily again to West Europe, USA, Japan, China. There are 7 companies under 2 flags. Now that's the reality. It's not only 7, 8 countries producing oil, but the companies which are producing oil do not belong to those countries. They are just 2 flags. For example, they are integrated multinationals. So 2 countries are American and European Union. They have monopolized the production of oil. So blaming OPEC is not enough. It's basically the political leadership of America and European Union. I would not call political leadership. It's the industrial leadership that is responsible. But the political leaders can always tighten the screws. And if you look at the political situations, because of the oil, you will see the first was Iranian oil in 1951, nationalization. That created a global crisis, followed by Suez crisis in 1956, Arab Israeli War of 1967, October War of 1973, Iranian Revolution 79, Iran-Iraq War of 80 to 88, and Iraqi invasion of Kuwait in 90, and now most recently, US invasion of Iraq. Now another problem is, apart from the political situation which I have talked to you, oil is an inventory stored at a zero cost. It's exhaustible, it's non-renewable, and in case there is a decrease in supply, it will take thousands of years to have the fossilized fuel. So the production costs also vary. The marginal cost of production is lowest in Saudi Arabia, and it is at $8.98 per barrel. It's highest in UK at $44.33 per barrel. And this is a tragedy, Canada has $26.24 per barrel. So Saudi Arabia, having the lowest production cost, is luckiest for the oil. And it just gives it three advantages: abundant pool of oil, close to the surface, close to the sea, public ownership, and no tax on production. If you remember, the cost is also low in Iran and Iraq, but higher than that in Russia and in USA. Nevertheless, oil prices fall. In 2013, oil prices dropped below $20 per barrel. It happened again in 2016. And that's a tragedy. When the prices fall, then the supply stops. But the supply stop effect has felt over the years, not immediately. Some believe that the Saudi Arabia was ramping up production to eliminate the American fracking industry. That's not so. As a matter of fact, every increase in the price means more money to the OPEC countries. And the political considerations are always overwhelming. USA is a swing producer. US production grows dramatically over the last decade. And USA has very close relationship with Saudi Arabia. In fact, if Iraq produced and exported not oil, there would have been no first and the second Gulf War. So oil is not to be taken as a commodity which is impacted by demand supply. It is a politico-military product which is manipulated by two major international companies having several subsidiaries, and that gives people misinformation. They think, well, there are at least 20 companies doing it. So no, it's two multinationals which are controlling the global scene. Somebody might say, yes, one person has just objected, and India, they are refineries. They are refineries, exploration refineries, and the total exploration is minuscule. It cannot even meet the demands of one province in India. What to say of the Indian national need or international need? Every country has some small reserves, but those small reserves are minuscule. They cannot compete with Venezuela, Russia, Middle East. And, therefore, when the prices rise, the political opponents of the government in power take advantage of crying hoarse from the housetops. Well, the prices are falling and the government is not controlling it. And the political masters in most of the countries like Canada say, well, this is a supply-demand issue. We can't help it. If OPEC countries are cutting the supply, we can't help it. They refuse to admit that they are manipulators as well. And in countries like India, where the prices are fixed by the government, not by the market sources, they have their own overheads. So with every increase of 10 cents, if the increase is 10 cents, the real increase is not 10 cents, the real increase is 13 cents. Because 3 cents are in overheads to be skimmed off. So the biggest scam in the fuel charges is the will of the political and industrial leaders, or I wouldn't say the will, I'll call it a nexus between the two. And nexus is responsible for these fluctuating prices. Prices at the pump, they don't depend on anything. They all depend on politics. And in case there is a selfless person at the helm of affairs, the prices would crash. As a matter of fact, the supply is sufficient enough not only to meet the demand but overwhelm the demand. And if the supply demand forces were to operate, the prices would be at least 2/3 of what they are today. And they are not that because of the intervention, subtle, hidden, and sometimes open, by the politicians. So don't blame anybody else except the political machinations for the fuel prices. If the political machinations with fuel, oil prices, and you are the victim thereof, of their machinations and their conspiracies to help each other rather than to help the general public. Thank you.